Hey, what's up, guys? It's your boy 007. My goal here is to help you guys become better investors and better traders in the stock market and help you guys along the journey, and hopefully you guys get rich. This video I wanted to do is I wanted to cover a little bit in terms of long-term investing, and kind of go over my strategy. That's kind of a combination of a periodic investment strategy along with like dollar cost averaging. So my strategy is somewhere in between. It's kind of very similar, and it's what I use when I'm doing my long-term investing plays and dividend investing and stuff like that. So, and also if you guys haven't seen the last video about risk management, make sure to check that out. It's on my YouTube channel. It goes a little bit more about bracket orders and risk management also, which I think it's essential for everybody learning to get into the stock market and things like that. So this one, I want to cover a little bit more about the periodic investing strategy. And what that does is that, similar to dollar cost averaging, where an investor it's investing same amount of money every month, kind of like your 401k and stuff. Similar how if you have 401k at the company or a retirement fund at your company and you're contributing an X amount every month, this is kind of very similar to that, except in the 401k. The 401k, you contribute money every month or every 2 weeks based on your paycheck, and then after you do that, they take that money that you put in and they invest it into the same fund that or same stock fund or same mutual fund or whatever every month at whatever cost it is at that time. And that is what the true dollar cost investing strategy is. So an example of that is kind of like where Joe works at ABC Corp and has a 401k plan. He receives a paycheck of $1,000 every 2 weeks, and he decides to put 10,000 or $100 off his pay to his employer's plan. So kind of like what I said before, and then he chooses to contribute 50% of his allocation to a large cap mutual fund and 50% to the SPY S&P 500 index fund. So every 2 weeks, 10% or $100 of Joe's pre-tax pay will buy $50 worth for each of these two funds, regardless of what the fund is at. The fund could be at like, a SPY could be at $300.34, or it could be at $320. So that's how dollar cost averaging works. And the reason that this is very, very effective over time is because, as you can see, let's take a look at the S&P 500, right? In in the long-term chart. So this is the S&P 500 is a great representation of what the stock market is, and they kind of pick some of the top 500 stocks and stuff, and they put in this TTF. So as you can see over time, even from let's say even if you started investing in 2007, where the stock market was very hot, it was deemed very high, and you bought S&P at $157, right? And then every month after that, so you bought it at the top 157, then the next month you bought it at like 149, and then so on, and every month you just keep cross averaging, and then some months you'll be buying at the bottom here at like $75. So, and then just so on, so your average is somewhere in the middle here, right? And as you hold that fund over time, as you can see over here, the stock was at 155, now is at $333. So as you can see over time, the stock grew, and as you dollar cost average, you're gonna have a way better average because you started your average lower. So you're gonna have a way better average even over here and stuff. So you'll still be profitable, you'll still be up, and especially if the stock pays dividend, that means you're locking in some of that profit. You're locking in whether it's 5%, 3% every year when the stock is paying dividend. That's what I like about dividend stocks. So that even if the stock crashes at some point, you'll be locking in some profit, and you can use that to invest into other stocks. That's why I started this dividend investing strategy, because it allows you to we use the dividend cash to invest into new stocks, so you can continue to diversify your portfolio as the market environment is consistently changing over time. And in addition to that, when these companies pay you the dividend, right? Most of these companies, some of them they pay you dividend every month, some of them pay you dividend every 3 months. So when they pay you these dividends, I don't reinvest it into the stock. I just let it sit in cash in the account. So this way I'll have the extra cash, and then when there are some months where I can't add $100 to the account, or $500 to the account periodically, if I can't add it, I'll still have extra 500 left over from these payments, and I can use that to consistently cross average and keep investing in stocks, every month. So this way I have a better cost average and I'm always diversifying. So this is just some of the key takeaways. You got to figure out how much cash, how much spare cash you can put into your account periodically, whether it is monthly or quarterly or every 3 months. And this is one of the main keys. You got to keep putting money every month or every 3 months, because the market constantly goes up and down, up and down. This is so we'll look at the market on a weekly basis, right? This is the market on a weekly basis. Some weeks it's up, most weeks it's up, and then some weeks it's down. And you want to be able to catch those downtrends. So that's why I always advise people to put in money monthly, so that you can always be able to catch the trends. Some people, if they want to time it better, they could do every 3 months and try to time it every time the market goes back down. They start to buy it. But that's if you just want to try to invest in the general market, which is SPY. But I like to diversify a lot more, because you tend to get higher reward when you diversify into individual stocks. Not always, but majority of the time. And the goal of doing this, as I said before, is just to reduce the overall impact of the volatility on the price of the stock market. So that's why I started with the dividend investing. So a lot of my stocks that I pick, I post them every month. So it'll be like this. Like this was October, I posted up, and I usually spend hours of research and careful consideration. I pick these long-term stocks that that are always financially safe, financially stable, which means it's almost literally impossible for them to go bankrupt. And then I'll find price entries based on algorithm levels that the algorithm would buy, like the computers would buy. So they might not always be the current price. They might be a lower price most of the time, where I think the computers would buy, and that's usually a great entry point. Those are some technical levels and supports that you can get in. And most of the times it'll happen. Sometimes it may not happen. But regardless, we'll have that order set. We'll have it set and ready to go if it does happen. And then in addition to that, in these picks, I also attach fundamental reports to some of these companies too. So you can kind of like see what the company is about. So these were some of the companies we picked, and you can kind of see what, like in detail, what the company does and things like that. Whether it really fits your needs and how you feel about it. Because I mean, these are companies I picked that I'm confident that are going to be strong, but you might have to review them individually. So sometimes the report, let me just give you an example. Sometimes the report will look like this. Like one of the company I picked is Raytheon Technologies. They're a big company that tells you over here that provides tech products and service to building system, aerospace industries, and they have government contracts and stuff like that. So I think something like this will always stay around for a long time. I checked their financial sheets. It looks very solid. Their price to earning ratio is great. Their forward earning is not bad. It's 20, and even though they don't pay the highest dividend, they only pay a 3.1% dividend. They have opportunity to grow over time as a company, and that's what I like about them. The stock's current price is 62. 52-week high was 93, 52-week low was 40. So this is what the fundamental report contains. It gives you a bunch of, good information if you want to look deeper into them, understand why I picked them or why I think they're a great company and things like that. This is just more information, more data. If you want to, you could look through this data. It's up to you, If you don't, if you have just trust in me and you believe that I'm always picking the best stocks for you, then just buy it and forget it, Kind of like that. And I'll show you. Let's see if we can show you one of the stocks we picked. So, like for example, some of the dividend stocks that we picked in March, like Coles or RGBLY. So some of these stocks people may not never heard of, but I always do my research and make sure what they do. I know what they do, and I know they have potential to grow. So RGBLY was one of the picks. Hold on, let me go back. RBGLY. So RBGLY. So this was a company I picked out in March. And one of the reasons I picked this company out was because we had the whole Corona situation going on that was like exploding between February and March, right? And I was looking to it. I was like, man, I wonder what company makes disinfectants, Lysols, and things like that, right? And I looked up Lysol, and I found out this company is the company that's responsible for making Lysol. Now we searched more and more into it, and then and I found out they not only make Lysol, right? So you see Lysol here. They make Mucinex, they make Durex, which is like a condom brand, and a bunch of other stuff, man. This company is huge, right? So a bunch of these other brands from different countries and things like that you may not heard of, but these are all very related to health and hygiene. So I was looking at them. I was like, man, this company is going to thrive. This is a European company, a UK company, huge company. I was like, man, this company is going to thrive regardless. No matter how bad the stock market crashes, they're going to thrive because they're selling all these stuff that are going to be essential, and it's only going to get even crazier. Like people are only going to even use this even more and more, so their sales are going to continue to grow in the coming years and whatnot. And we still haven't even seen that increase in sales yet, but it will probably happen. And in addition to that, they pay dividends. So I was like, you know what, why not? So we picked this stuff up around here on the bottom, and now it's going for like $20. Bought it for $13, it went to $20. Huge increase, man. So that's just an example. And so a lot of these stock picks. So I want to go over how to read a spreadsheet too, so to give people a little better understanding how to understand it better. So this is one of the stocks, RBGLY. This is the price now. This is the sector is in. So this section tells you what the price is at, and this section tells you what the sector is in. So consumer cynical. Well, this is always a great sector to buy when you're worried about a depression coming or a recession, because these stocks definitely never get hit that hard. And then these are the price entry that we're looking to buy at. And then these are some of the price targets that we could ideally sell at. So $19 was one of the price targets. And then these are the optional trailing stop losses. And what I mean by optional is that like ideally you could, ideally I always want to go into a trade with a stop loss, but you don't really have to follow these stop loss. You could take them, or you could just leave them off when you're doing the trade. It's good to have most of the time, but majority of these stocks that I'm talking about, if you're investing for long term, if you're not worried about money, worried about like taking money out of your stock account, and you're okay with keeping this money in for a while, don't really have it. Just leave it, because a lot of these stocks are just gonna grow over time. It's a guarantee. Like, because I pick stocks, I research them, I make sure they have opportunity for growth and recovery, and I make sure that they're fundamentally safe, like they can't go bankrupt, so you can hold them for as long as a year or 2 years, so you don't have to panic sell. But this is optional. It's good to have it sometimes when the stock runs back up. So like, for example, something like this, if you bought at 14.84 and it ran to $19, you can set a 12% stop loss. And what a 12% stop loss does is that it's gonna take 19.29 and it's gonna put and if this stock drops 12% from this current price, usually you can put a stop loss after it runs a lot, so that when it hits this, after it drops 12%, it will auto sell, but you'll be locking in profit at this rate. So if you bought it at $14 and it already went up past 30%, right? That's when you want to start putting a stop loss of 12%. And a stop loss of 12% from this $19 mark would be $16.97. So what that means is, if this stock drops to $16.97, it would automatically sell. But this number moves up and down as the stock goes up further. If the stock goes up more, this number will move up. If the stock goes back down, this number will not move. That's how the trailing stop loss works. So I'll post an article where you can read a little bit more about trailing stop losses. And it's a great feature, and what it does is helps you lock in the profit. So that trailing stop loss would be at $16.97. Your buy-in was $14.84. So you still make a few dollars from that, and in addition to that, you're getting dividend payments from it too. So you'll be locking in some great profit if it ever hits it, and you'll never sell it at loss. But most of the time, I don't like to put the trailing stop unless I had the stock for more than 1 year. Like if I had the stock for more than 1 year, so this way I move into the long-term tax bracket. And B, only if the stock hits the 30% profit target. That's the only time I would put the trailing stop loss on. Any other time, I would just consider an opportunity to average down some more. And then this section, I will kind of go over the forward PE. So the forward price to earning ratio. Generally, the lower is better. Anything under 15 is great. But sometimes it depends on the sector. Like tech sector, the PEs are ridiculous. Some of them are 100, some of them are 50, some of them like thousands. So those are much harder to gauge. So that's why I usually don't invest in the tech sector as much, unless I see a great opportunity like this one, which is Northern LifeLock. This is an amazing opportunity stock. If you're not familiar with LifeLock, they're like they protect your identity and stuff like that. And I think as the internet continued to get crazier and crazier, these companies are just going to continue to make more money and so on. So that's why I really pick them, but when I do, I try to pick the safe ones. And then over here, I indicate what the risk factor is. The lower is better, of course. So the risk factor of this stock is 3 out of 10. I was so confident in it. Some of these risk factors are determined by the company's financials, the company's future profits, and then what I think about the sector and things like that, and what their opportunities are and everything, and how strong their moat is, how good their competitive advantage is and whatnot. So and just the industry in general. So that one had a very low risk because I was very confident in it. And then over here, it'll tell you how much dividend payout, how many percentage of dividend they pay per year. So this company pays 3% of the stock price in dividend. And over here, it'll tell you what the next month that they're gonna pay the dividend. And then over here tells you, and you can adjust this as needed too. All you have to do is change the dollar amount from 500 to 100 or whatever amount you're thinking of contributing per month. So over here, this just breaks down to how much shares you would buy if you were to invest $500 a month or a quarter. And this over here just kind of gives you the full read on what the company does and things like that. But you can also see that in the report too. This just gives you a quicker read if you want to look into it. Just double click it. Tells you what they do, and whatnot. And that's pretty much the breakdown of how to read our dividend spreadsheet and how to invest using our dividend spreadsheet and whatnot. And understanding the concept and the reasoning that come behind them. And then sometimes you'll find companies that the prices are different than what you see here too. And sometimes the price will be much lower than our buy-in, and that's when you have to kind of average down a little bit. And sometimes I'll issue an average down too. I'll tell you too. But majority of these companies are very safe and they have great opportunities to go up during the long term. CSV was another one. This was another consumer cynical company. The buy-in price at that time was $17, and the price now is $23. So let me show you this company. So that was in March. That was one of the picks we picked up in March. And now keep in mind, like the gains aren't like the best gains in the world, right? But they were good. They were still better than some of the other companies, and they're safe. Sometimes you're not gonna get like crazy gains, like 100% gains, because these companies are safe companies. They're not gonna break or they're not gonna die, so they won't drop as much. But this was one of the companies, carriage service, and we bought them around here at this level. I personally averaged down a little bit more around the $13 area, and now they're at $20 something. And what this company does is they're like CSV. They're kind of like a funeral home company, and I mean, in March, coronavirus is going crazy, right? It sucks to think about that, but the fundamental outcome was that people were gonna die, and if people are gonna die, these companies are gonna get more business, and as they get more business, they're gonna make more money, and that's just how stocks work, right? As they make more money, people are gonna make more money, and from buying the stocks, and there's opportunity for the business to grow. So these are some of the reasoning why I pick some of these stocks, and what I look for to see what the opportunity for growth are. And then sometimes we'll alert these prices that may never hit, and that's just how it is, right? It's like over here we alerted Airbus, which is a competitor to Boeing. There's only like 3 big companies in the world that makes airplanes, commercial airplanes. And that's pretty much Airbus and Boeing and another Chinese company, but the Chinese company isn't listed here. So we got into Airbus at $26, and then we averaged down somewhere around 13, and it went up and down. Could have sold some at $16.90, but this is where you would put the trailing stop loss, so that you can never lose more than you got in. But one example of some of the prices that we put that hasn't hit is this one. It's called Waste Management. We alerted this in May, and it's a public utility company, American Waste Company, huge company, great opportunities, solid financials, everything's great about this company. And in May, so right now it's $113, but we alert a buy at $48, $49, because I thought that the market might drop again, and if it did, I felt like that would have been a great area to buy it, based on some technical levels. So, but in May it was around, so we alerted that May 1st it was around here. It was around $99. It moved up a little bit more, it moved up $10 more. So that stock we didn't have an opportunity to get in, but you should still put that as a buy in your account, or just keep track of it as an alert in case it does happen, in case it does get there. So I'll probably alert a new price for that later on. But generally, anytime when you see these monthly release, I usually tend to release 5 stocks. Usually at least one of those stocks is very close to the price. So what you want to do is, if you're gonna invest like $500, or let's say you're gonna put aside $2,500 a month, right? For easy math, say you want to put $2,500 a month, and so let's say for right now it's March, you want to put in $2,500 a month, and you set to buy RBGLY. RBGLY. Gotta do is click buy. If you put in 500, it will tell you to buy 34 shares, right? Otherwise, you just take whatever amount you're looking to buy, whether it's $100 or $500, and you take that and you divide it by 1484, and tell you to buy 6.7 shares. You could either round that up or round that down, however you like. And you put, 7 shares. If you like the stock, you buy more. If you don't like it, you buy a little less. Put 1484, and just set it and forget it. Just leave it at this price, and just forget it, And then once it hits, it hits. If it doesn't hit, oh well. So this way you're never chasing, you're always investing for long term. And not every single one of these are gonna hit, but when it does hit, it's gonna be at a nice technical support level. That's gonna be a good investing opportunity. And that's pretty much it for our video. If you appreciate this video and you want to subscribe to our dividend picks, feel free to go to my Patreon page. It's only $9.55 a month. That's less than 35 cents a day. And you get access to the dividend picks, you get access to the videos, you get access to news and things that change every week if you want to be a little bit more involved. But as always, I highly suggest, even if you're a day trader, if you're an options trader, I highly suggest always have a separate portfolio just for long-term investing. Because day trading, you can make a lot of money or you can lose a lot of money. But at least if you have a long-term portfolio set aside, that money you'll never ever lose. It'll always be with you for a long term. And if you just set it and forget it, and it's just like for example, one of those stocks where if you just buy any of these stocks and you just kind of left it for a long term and just forget about it, it's always gonna go up over time, man. And CSV. So as long as you're investing in it and just leaving and forgetting it, it's gonna eventually go up, because there are things that cause the stock market to go up over time, and one of those things are inflation. Things of products go up over time, so that's why everything else goes up. So a great example is like milk and egg. Milk and egg might have been like $1 or $2 back in the day, or even metro cars in New York City, right? Train fares, they used to cost $1.25, now it's like $2.50 or whatever. And because these price of the product go up over time, the company will always make more. The company will continue to make more money over time, and as the company make more money over time, their share price are gonna go up over time. So that's just a fundamental reason of why you should always invest for long term. And that's pretty much it, guys. I hope you enjoyed the video. I hope I was able to help you out and give you a better understanding of the market. And if you have any questions, you can always feel free to hit me up on my Twitter. Just look up 007 Wall Street and just send me a message. And I'll try to get back to you as soon as possible. And that's pretty much it, guys. Thank you for watching and have a great day. Take care.